All right, today we are going to crack the code on a tool that is honestly super powerful for any trader, open interest. We're going to use it to figure out what the market is actually thinking, to get way beyond just staring at a price chart. You ready for this? Let's jump right in. So, here's the game plan. First, we're going to decode the market's basic language. Then, we'll hunt down those super clear bullish and bearish signals. After that, we'll get into the trickier stuff, the sideways scenarios. And finally, we'll pull it all together so you can turn all this data into an actual decision. So here's the big one, right? Is the market bullish, bearish, or is it just bluffing? It's the question every single one of us asks every single day. Look, a price chart tells you what already happened, but what it doesn't always tell you is the conviction behind that move. Is there real money, real momentum there, or is it all just noise? Well, open interest, that's our key to finding out. Okay, let's kick things off with the absolute fundamentals. You got to think of this first section as learning the basic vocabulary. I mean, before we can crack the market signals, we need to understand the words it's even using, right? First things first, what in the world is open interest, or OI? The easiest way to think about it is like a head count for the market. It's not about how many trades happen today. That's volume. Nope, this is about how many contracts are still active, still open. So if you see OI rising, that's a huge clue. It means new money and new players are jumping in, which signals a growing conviction in the market. Now, let's break down the battlefield. It's actually pretty simple. You've got two opposing teams. On one side, you have the call options. These are the bullish bets, the traders who want to see the price just shoot for the moon. And on the other side, you've got put options. These are the bearish bets from folks who are hoping the price takes a nosedive. This fundamental clash, this is what drives literally everything. All right, with those basics down, it's time to decode our first major signal. How can OI tell us when the market has that strong upward push? This is what a clear bullish market looks like through the lens of OI. And this is the secret code right here. The most powerful bullish signal is a combo of two things happening at once. First, you get what's called a call long buildup. All that means is that new buyers are rushing in, betting on higher prices. And at the exact same time, you get a put short buildup, which is just a fancy way of saying sellers are betting that the price won't fall. See how those two work together? And this table just shows it perfectly. Look what's happening under the hood. For both calls and puts, the premium, that's the price of the option, is going up, and the open interest is going up too. Now you might be thinking, wait, why is that bullish for both? Well, think about it. The call buyers are actively paying more to bet the price will go up. And at the same time, the put writers, the sellers, are confidently taking that money, betting the price won't go down. Both of these forces are pushing the market in the same upward direction. It's a team effort. So the key takeaway here is just so simple. When you see this pattern, it's not just a hunch, it is a loud and clear signal of conviction. The market is showing you it has real strength and a collective will to push those prices higher. Okay, so now let's completely flip the script. Every code has its opposite, right? And the market is no different. Let's move on and see how this all builds into the bearish signal, that clear sign that the mood is turning sour. The bearish code is basically the mirror image of what we just looked at. It kicks off with a put long buildup as traders scramble to bet on a price drop. And this gets combined with a call short buildup where sellers are basically saying, nope, the price has hit a ceiling and there's nowhere to go but down. And once again, the data tells the whole story. Premiums and open interest are rising for both types of options. The put buyers are all in on the market falling, and at the same time, the call writers are working to stamp out any attempt at a rally. When these two groups align, you get this really powerful downward pressure on the price. And the takeaway here? It's just as clear. When you spot this pattern, it's a strong indicator of a collective belief that the market is heading for a fall. There is genuine, measurable strength behind that downward move. Okay, so we've covered the straight up and the straight down moves. That's the easy part. But what happens when the market just seems stuck? Just bouncing around with no real direction? Well, those are the sideways scenarios. And believe me, they have their own unique codes to crack. This table is fantastic for breaking down all the little nuances. So let's walk through it together. First up, a true range-bound market. Here you have sellers on both sides building up their positions. The call sellers are creating a price ceiling, and the put sellers are creating a price floor. The price is basically trapped in between. Okay, second scenario, a positive bias. Now here, the open interest for calls is falling. That means the bullish traders are cashing out, taking their profits. But at the same time, the OI for puts is rising as sellers hold the line, which stops a big drop. So what does that tell us? The upward momentum is fading. And finally, the negative bias. It's the exact opposite. The put buyers are heading for the exits, so their OI drops, but the call sellers are still in the game, putting a cap on any rally. The downward pressure is easing up, but there's just no strength to push higher. These are really subtle but absolutely critical distinctions to understand. So, we've learned the codes, we can spot the signals. Now, for the most important part of all, how do we take this knowledge and turn it into an actual, concrete plan of action? Let's go from data to decision. It really just boils down to this simple three-step process. Step 1, you analyze the OI data. You're looking for who's building up positions and who's getting out. Step 2, you translate that pattern into one of the sentiments we've just talked about. Is it bullish, bearish, or sideways? And then step 3, you make your move. You go long in a bullish market, you go short in a bearish one, and this is just as important, you learn to be patient and wait on the sidelines when the market is going sideways. Sometimes the best trade you can make is no trade at all. But there is one more factor. A wild card, really, that can pretty much override everything we've just discussed, and that's volatility. Big news events, think elections, budget sessions, that kind of thing, can cause these massive, sudden price swings that can totally ignore the underlying sentiment we're seeing in the open interest data, at least for a little while. And here's the thing, volatility isn't just some vague feeling. We can actually measure it. We use an index, like the India VIX you see here, to get a read on it. A high VIX number basically means the market is expecting bigger, faster, and maybe even wilder price moves. So what does that mean for you? Even if your OI analysis is screaming a clear signal, high volatility is like a big yellow warning sign. It's telling you to be cautious. Maybe you use smaller position sizes, or maybe you just wait for all that anxiety to calm down a bit. When you get right down to it, open interest gives us this direct line into the market's collective mind. It shows us where the real money, the real conviction lies, way beyond all the noise on a price chart. The patterns are there, the signals are being sent out constantly. So the only question left is, are you ready to listen?